The entire market boils down to one question right now. Is AI a generational supercycle, or is it just another speculative bubble? We're going to cut through the noise and find some practical, risk-aware setups for the next 1 to 2 weeks.
All right, here's the game plan. We'll start with the headline risks, the stuff that can move the market this week. Then we'll dissect both the bull and the bear arguments for AI. After that, we'll get into 2 specific setups and talk about how you could potentially use options to trade them.
Before we even get into the whole AI debate, we have to look at the immediate macro risks. These are the events that are going to create volatility and, frankly, define our entry and exit points. Okay, 4 things are on the radar. First, the CPI report. If that number comes in hot, you can bet it'll reignite rate hike fears and smack tech stocks around. Second, the US-China meeting. Any negative headline there could trigger an immediate risk-off move. Third, this government shutdown. It's a slow bleed on the economy, now on its 24th day. And finally, keep your eyes glued to the 10-year Treasury yield. If it breaks above that critical 4% level, it's going to put a lot of pressure on stock valuations.
And all of that brings us right back to the central conflict in the market. Seriously, pretty much every major move from here on out is going to be driven by the answer to this one question.
All right, before we dive into the 2 big market theories, here's our standard disclaimer. This is for educational purposes only. We're just analyzing public data to help you stay informed. It is absolutely not financial advice, so please do your own research.
First, let's break down the bull thesis. And listen, this argument isn't about hype. It's about a tsunami of capital investment that is literally reshaping the market in real time.
Take a look at this number, $500 billion. That's the projected capital spend from big tech on AI data centers alone over just the next 12 months. This isn't some fuzzy forecast. It's a tidal wave of cash that's hitting the system right now. It's a completely unprecedented level of investment.
And here's where that money actually goes. I mean, that capital expenditure has to land somewhere, right? For a company like Micron, which makes the critical memory chips for those data centers, it translates into absolutely explosive triple-digit growth. We're talking year-over-year, earnings per share up 157%, and revenue in their cloud business up a staggering 214%.
Okay, but on the other side of that trade, the counter-argument is just as compelling. The bears are looking at this frenzy not as some new paradigm, but as a direct replay of the dot-com bubble. And you know what? The parallels are really hard to ignore.
Just look at the sequence here. Back in the late 90s, the Fed cut rates, which fueled the bubble. Then they started hiking in late 99, and the whole thing came crashing down. The parallel to today is pretty stark. A huge rally fueled by years of low rates, now staring down a rapid hiking cycle. The playbook looks identical.
And here's the fuel for the fire. This isn't just companies using cash on hand. It's debt. U.S. tech firms have issued $157 billion in new bonds this year alone. That's a 70% increase year over year. This boom is being financed with leverage, which massively increases the systemic risk if or when this cycle finally turns. So for anyone leaning bearish, this quote is everything. The biggest risk isn't about being wrong on the thesis. It's about being too early. Trying to short a parabolic trend that's fueled by this much capital and this much debt is a very, very high-risk proposition. Timing is everything. So, what's the move here? How do you trade this conflict? Well, you don't bet on the grand narrative winning or losing. Instead, you find specific stocks where the market's AI story is totally disconnected from the company's actual fundamentals. Let me show you 2 of those dislocations right now. First setup, Adobe. This is a classic disconnect. The stock has been punished. It's down 27% over the last year, all because of a negative AI narrative that says its business is at risk. But the actual business? It just posted a double beat on earnings and revenue, and it raised forward guidance. See, the market is pricing in a fear that the fundamentals just aren't validating. Now, the second setup is a totally different story. It's a turnaround play in Molina Healthcare. The stock got hammered, dropped 20% after earnings because of margin compression. But when you break it down, the problem is really isolated. Their core Medicaid business, that's 75% of their premiums, is still stable and profitable. The entire drag is coming from this tiny ACA marketplace segment, which is only 10% of the business.
And management isn't just sitting around. They have a clear 3-step plan to fix this margin issue. It's a playbook they've actually used successfully before. They're pushing aggressive rate hikes, around 30% on average. They're getting out of unprofitable markets, and they're buying back their own shares. Each one of these steps is a potential catalyst to get the stock to re-rate higher.
Okay, so let's translate these setups into potential options structures. And to be clear, these are not recommendations. They're just examples of how you could express a thesis while defining your risk.
For Adobe, you might consider a bull call spread ahead of their earnings on November 11th. It lets you play for a positive surprise, but with a defined max loss, and you can capitalize on that post-earnings volatility crush. For Molina, the thesis is more about long-term value, so selling cash-secured puts could make sense. It allows you to collect the elevated premium from that recent price drop, and if you get assigned, it defines a lower entry price for the stock.
Look, regardless of the setup, no matter what structure you use, these principles are absolutely non-negotiable. You define your max loss before you enter the trade. You know your invalidation levels. You understand the risk of implied volatility getting crushed after a catalyst. And most importantly, you size your positions accordingly.
And one last time, just to be perfectly clear, this is not trading advice. This is just a market update to keep you informed. Markets carry significant risk, so trade your own plan, manage your downside, and always verify all the data.
So we end right back where we started. Is that $500 billion wave of capital the beginning of a true generational supercycle? Or is that $157 billion in new debt a massive warning sign of a bubble that's about to pop? The answer to that question is going to define market returns for the foreseeable future.